G'day taxpayers. A bit of a preview of the RBA announcement, which is tomorrow afternoon. And of course, the rate cut will be delivered. The question that the board, the Reserve Bank Monetary Policy Board, will be confronting as it's sitting down to its cup of Earl Grey tea and iced Vovo biscuits is the 4.1% cash rate that is currently in play appropriate for the economic fundamentals? Let's take half a step back. We know, and the RBA acknowledge this, that the 4.1% cash rate is restrictive. Now, without getting into too much economics jargon, that means that the level of interest rates, the stance of monetary policy, if you like, is actually causing economic growth to be weaker than if rates were neutral. It's causing the labour market to be weaker than if rates were neutral. And it's putting further downward pressure on inflation than if rates were neutral. Now let's have a look at a couple of those things. We know that economic growth, we get the March quarter GDP numbers in about 2 or 3 weeks. They're going to confirm that annual GDP growth's somewhere around about 1.7-ish%. Pretty soggy, wouldn't you think? Yes, is the short answer. We saw the labour force numbers, and despite the lovely headline employment growth number, there's signs that hours worked and the unemployment rate are consistent with the economy being somewhere, away from Nehru. And we know that from the wages data, which shows that wages growth is in the groove of that 3 to 3.5% range, and that's entirely consistent with the RBA's inflation target, and if anything, there's no sign that wages growth is going to be spiking above 3.5%, which might be a moderate concern, but for the here and now, not a problem at all. And also importantly, the inflation rate is currently 2.5%, give or take a tenth, depending whether you're looking at monthly or quarterly, headline, trim, mean, slice and dice it whichever way you want, and you get 2.5%. So, if the RBA doesn't move the cash rate towards a level that even it thinks is neutral, that is not putting upward or downward pressure on growth, inflation and the unemployment rate, we've got to have about 100 points of rate cuts delivered, and delivered relatively soon, or else we get to the end of 2025 and into 2026 and the economy is going to be pretty soggy. And that's not good news. Inflation will be too low, unemployment will be too high, wages growth will be too low. So not good news if it keeps policy too tight for too long. So I think they need to get towards that low 3-ish% on the cash rate sooner rather than later. Hence the call for a 50-point move to get us to 3.6%. So still slightly restrictive, but getting us to that point anyway where monetary policy is no longer a handbrake on economic growth. So that's the fundamental reason why rates should be cut, will be cut. The debate over 25 or 50, well, that's always fun to have a bit of a quiz about that sort of stuff. But I think the RBA need to get there. If they don't cut rates reasonably aggressively on Tuesday, then of course we'll be watching the economic data flow. And if there's any downside risk to growth, the RBA will be wearing that as another sad call on its inability to be forward-looking, preemptive, and setting interest rates to the economic outlook, not looking at the rearview mirror to what wages and inflation were a year ago or thereabouts. It's been a problem it's had for, a decade now. All the best for tomorrow afternoon.